Hi, Ankur. Good
Hello,
afternoon,
thank you.
and good to have you today on this edition of Fables of Aesop, as we call it. And I just read about you recently about Nuclei and a very unique employee stock compensation or equity-linked stock compensation program that you have instituted at Nuclei, and that nudged me to reach out to you and learn more about SARs or stock appreciation rights. But before we get into that, Ankur, it would be very interesting to know the journey of Nuclei itself. It's very interesting to note on your website that you call yourself someone delivering consumer tech DNA to banks. Now, what do you really mean by that? Can you elaborate? And what does Nuclei do?
Thank you for having me on this podcast. I really appreciate it. At Nuclei, we were very clear from day one that we wanted to run a sustainable business. That drove our choice of which industry we wanted to work with. That also drove our choice in terms of what kind of products we wanted to build. So whether it was a B2C product or a B2B2C product, right? So we were very clear about these aspects or guide rails from day one. Uh, while doing market research back in 2018, we realized that banks were kind of slightly lagging behind in terms of various other consumer tech companies, whether it's your Paytm, PhonePe, Amazon of the world, right? And not just in India, across the globe. This was happening across the globe. When they had to step up their game. They had to move away from thinking about digital development from a services perspective to thinking about using products to increase and better their customer experience. So that's where we thought that there was a significant gap, and we thought we could fill that gap partially through the products which we could develop, right? So therefore, the idea that we will deliver a consumer tech DNA to the bank and make sure that the bank's customer experience becomes much better. Uh, Obviously, there are many variables, many players, multiple things at play. But whatever products we could build, which will have a maximum impact on the customer's experience, we wanted to build those products.
Sounds super exciting, and perhaps maybe the timing couldn't be better, I guess, with a lot of banks with a push to go more and more online. I guess so. Do you
Right.
see a lot of tailwinds because of COVID that's impacting in a positive way for you guys?
Yes, absolutely. A lot of banks who were not thinking from a digital perspective have at least started thinking about or have started, allocating a lot of time to digital assets which they need to develop. And of course, like that will have an impact across the globe. That will have an impact across the complete stack, whether it is, and this is not just only about the interface between the bank and the customers, right? The retail customers. This is going to have an impact across internal systems of the bank as well.
Right.
The movement to cloud will be much more accelerated now than it was in 2019. So all those aspects will come into the picture. And again, not just in banking industry, right? This will be across the world, across industries.
Right.
So we are seeing the same, like nothing surprising here. We are seeing the same trends in banks.
No, wonderful. And before we go into SARs and what you have done with your equity compensation, just one more curious question regarding why did you build this as a bootstrap venture? I mean, again, quite fascinating to see a bootstrap venture scaling. So, would love to know your thoughts on that.
One of the things which we promised ourselves was that we will think long term, right? And again, nothing against VC funded startups, right? Like there is a absolute need for that risk capital in certain models. In our model, that kind of risk capital was honestly not required. So there was no need for us to raise that much amount of capital and put it at risk because it was not required. Uh, Plus, like
Right.
again, like you learn from your own experiences, you form your own biases from your own experiences, right?
Right.
So if we wanted to think long term, it's very difficult to do that when you have 12 months of runway. You can't think 3 years or 4 years down the line, right? Like you start taking
Right.
decisions which will help you raise the next round of funding so that your company survives. And you go into that survival mode, you're continuously in that survival mode. We wanted to get out of the survival mode and have the courage and the ability to take long-term decisions where and these decisions are across the board, not just on the basis of what you develop, but also which clients you work with, which geographies you enter, even the people you hire. So today we have the luxury of hiring a person who has the right attitude, but not necessarily the right skill set,
Right.
and train that person over 6 months, and then that person works in your leadership team for the next many years. But when you have 12 months of runway, you do not have that luxury of hiring a person who doesn't fit in from day one and train that person for 6 months, because then you start thinking of that as a cost rather than an investment, right?
Right.
So
Okay.
this allows us, and this is again a luxury, right? This allows us to think of our team and invest in the team rather than think of them as a cost.
Understood. Understood. So you are anyways building this long-term thinking in the design of your hiring strategy, your kind of growth, but it's a chicken and egg, but I'm assuming you started with a little bit of capital and, kind of organically growing on top of it. It's good to know that you're cracking good amount of revenues early on in your journey as well, as I see it. Yeah.
So see, when we look back now, when we are in a state where we are slightly comfortable, okay, uh, in hindsight, when we look back in the for the like at the first year or so, it was difficult. Like bootstrapping a company, funding it on your through your own money or through revenue, it's never going to be easy. Unless, of course, you have a big chunk of money which you are investing. Of course, that's a different scenario. But we did not have that, right? So we were cutting it close in many months in the first 12 months primarily.
Correct.
But then after that, we have thankfully scaled up. We got lucky with a few deals, and obviously the team has worked very, very hard as well and delivered. We made a lot of mistakes along the way, absolutely yes. But we have learned from them. We are constantly improving. We are constantly growing, and that's the idea, that we continue to grow, continue to level up, continue to move forward.
Wonderful. And just how many banks do you work with?
We work with 18 banks right now
18
across
banks.
India and
Okay.
Middle East. Yes.
So great. I think that's giving you a good customer base to kind of now take your rocket ship in that sense, but in a bootstrap way. So quite fascinating to understand the journey, and thanks for sharing that. So switching over to the real reason why I wanted to connect with you, right? So I was very curious to understand. I'd already on all the academically I'd learned about all of these new ways, I mean, phantom stocks and SARs, etc. But obviously seen more of ESOPs. So would love to know about various things, starting with just your thoughts and your philosophy on equity linked compensation for employees through these instruments like ESOPs, SARs, RSUs, and why do you think it's important in startups, and how has it helped you in your journey in Nuclei?
See, again, I can't speak for all the startups. I speak for myself.
Yes.
When we speak about, again, thinking long term, right? You can't build a company just with 2 or 3 people. You need a dedicated team to build a company. And we were not thinking about building Nuclei and selling it in 3 or 4 years. We were thinking about Nuclei in very, very, very long term, right? Like for the next 25, 30 years, can we build? So obviously it starts with, can we build a company which survives the first 3 years, right? Then can we build it and extend it to the next 7 years? So the first 3 years is literally a building phase, right? 3 to 7 years or 3 to 8 years, the next 4 or 5 years is where you essentially slowly everything starts coming together and you grow. Post 7, 8 years is when you start growing, scaling up rapidly, because now suddenly all the product market fits of multiple products which you have, right? Now every product is settling down. Your name is being known in the market. Today, quite honestly, no one knows us. Maybe few people know us in India and Middle East, but if you look at a wider audience, no one knows about Nuclei. So it will take time. I'm not saying that it will not happen overnight. We are rational that way. So it will take its time. It will take another 4 or 5 years for us to have a stamp in the market. Now, when we are thinking about building such a long-term company, we also need to think about our team in the long term way. And whatever solutions we are building, whatever products we are building for the banks is, of course, they are important. But from our perspective, our core product is our team. That is what we are building, right? If we get the right team together, then of course we are going to ship out right product. Of course, our team is going to take care of our clients. Of course, then the company will be successful. So this product is whose product managers we are. We are the product managers of our team. That's how we think about the team. There will be a lot of features we'll have to build around this product to make sure that this product succeeds. Is our product, perfect today? Of course not. Like any other, product life cycle, we are in a building phase. Our product is also getting, iterated. There are multiple experiments which we are doing, and we'll continue to improve it. But the idea and the intent is very, very clear that our team is a product, and we need to continue to add new features and continue to improve it and make sure that it is better than what it was last year, and it will be better a year after now. So whatever helps
Wonderful.
our product become better are the features which are in our roadmap and which we will implement.
Right. So, wonderful analogy of looking at team and as product thinking, applying it to various abstractions. But why did you choose SARs or stock appreciation rights or ESARs, however you want to call it? What was the thought process around that? If you want to elaborate.
So again, like we explored both ESOPs and ESAs.
Okay. And Ankur, maybe if because for the first time audience, right, would you want to define what SARs are for our audience?
Sure. So, see, generally, a lot of startups have done ESOPs. ESOPs essentially are options which an employee gets at a predefined rate to purchase the equity or the actual shares of the company at a later point of time once those shares are vested. Okay. So,
Right.
generally speaking, what companies are doing is that, let's say you get 100 options, or rather, you get an option to purchase 100 stocks on day one of your company, right? So 25 of those stocks will get vested after a year. Every year, 25 stocks will get vested. Okay. Now, after a year, you now have an option to purchase 25 stocks from the company at a predefined rate. Let's say that rate is say 1,000 rupees per share, right? So once you have 25 shares which are vested or 25 options which are vested, you can actually pay 25,000 rupees to the company and get 25 stocks, actual shares in your hand. Okay.
Right.
Generally, and it will vest 25, 25, 25. At the end of 4 years, you'll have 100, and that's how it works.
Right.
Again, generally speaking, if you leave in between, then a lot of companies, and I know very few companies who have an extended,
exercise
period of exercise.
Yeah.
But a lot of companies give you only 6 months to exercise your option. Okay. So if you leave the company midway, let's say you leave after 2 years, you have an option to purchase 50 shares. You have to give 50,000 rupees to the company, purchase the shares. And there is a very high likelihood that there is no one else who is ready to purchase those shares from you, right? So you will essentially be sitting on that paper. So that's how ESOPs essentially work, right? It's a two-step process. Even at the point of liquidity, you have to first purchase shares from the company and then sell those shares to someone else. Whatever capital gains taxes in between, you pay that to the government, and essentially whatever residual money is, you take them.
Right.
ESARs, when we came across from a legal perspective and also from a compliance perspective and from an execution perspective, we thought across all these three perspectives, it was easier, simpler for everyone involved. Okay. So from a legal perspective, it's a contract between the company and the individual. So it is essentially slightly higher than ESOPs. Why? Because it's a liability which the company is taking up. Okay, if we just primarily speak from a financial aspect, it's a liability because it's a contract between the company and the individual. So company cannot go back on that contract. It's a signed contract between the individual and the company that this is the rate at which we are giving you this appreciation right now. At any point of time, whenever there is and these liquidity events obviously will be defined at any point of time, whenever there is a liquidity event, the appreciation from this rate to that rate is something which will be given to you. Okay, so that essentially comes from a legal perspective. From a compliance perspective, in ESOPs, you have a lot of compliances which needs to be done. You have to report it. If you have purchased shares, then as an individual, you have to report it, etc. In ESAs, it's, as I said, it's a contract, right? So there's no attached compliances other than signing that agreement.
Right.
The exercise is also a single step process. So you do not have to pay money to the company in the first step to take shares. Whatever is the appreciation, right? Whatever is the delta, essentially it gets given to you as a single transfer, and that's it. So from all those perspectives, it is much easier to manage. And of course, you can then design, because it's a contract, right? It's not something, ESOPs are regulated. There are certain guidelines from the government. ESARs are a contract, so you can make it much, much easier and, team friendly. So for example, we don't do annual vesting. We do monthly vesting and uniform across all 48 months, right? We do not lapse. So ESARs, even if you exit the company, they don't lapse. There's no exercise period. It's literally a contract for a lifetime between you and the company. So even if you leave the company after 2 years and the liquidity event happens after 4 more years, you still have the right. You will get the appreciated value. You don't need, I mean, and then there's no lapsing of those appreciation rights. So all
Right.
these things attracted us towards ESARs. Plus, as I said, we had the freedom to choose between ESARs and ESOPs, which I can't say for a lot of other companies. So we chose ESARs.
Right. No,
I
wonderful. I
hope
think
I gave you a detailed answer.
yeah, you answered pretty much a lot of the follow-up questions as well. So you also mentioned that there's concept of vesting as well, like in ESOPs, you also have concept of vesting in ESARs. But what does it mean? After I vest, uh, I will have to wait for the liquidity event to kind of unlock that value, or where is the liability of the company paying an employee come, basically? Yeah, just wanted to understand that.
So see, again, it varies from company to company. I can only speak about what we are doing. We decided that whatever profits we make every year, a chunk of that profit we will essentially use to buy back vested ESARs from everyone
Okay,
every year. Okay. To
understood.
start with, our first buyback is coming up in next 3 months. So in September, we are doing our first buyback. And to start with, again, these are things which we discuss in the open house. To start with, we are doing a cycle of 4 buybacks, every 6 months, and see
Okay,
how that cycle works. If we have to change it, if we have to make any amendments, if 6 months is okay, we'll do 6 months. If we can afford to do quarterly, we'll do quarterly. And if we have to do it annually, we'll do it annually. Then whatever is
perfect.
comfortable, I think the team will be involved in determining whether what will be much more comfortable, and accordingly we'll take that decision. But to start with, for the next couple of financial years, we'll do it every 6 months, 4 times, and then maybe in March, April 23 is when we'll decide, should we move to quarterly or should we move to annually, or we continue with half yearly buybacks.
Right. Oh, this is wonderful, and we talk about predictable liquidity for ESOPs, and uh, hearing that you're looking at a 6-month cycle is very heartening to hear. I hope a lot of startups think about that as well. And yeah, this is like real value generation. And just one aspect here, given that again this is a bootstrapped company, so you will not have a lot of market-based pricing, right? You don't do transactions as frequent. So how would you go about pricing your stock in some sense?
So
Do you take a
we do external valuation, but
Okay.
it's not frothy, right? So it's
Okay.
not an unrealistic valuation. We are valuing the company obviously to the best of our knowledge, in terms of, if at all the company has to be sold tomorrow as a going concern, what is a fair value which we could possibly get, is what we value the company at.
Understood.
If we have to value the company on the basis of, if we have to raise $10 million tomorrow, what is the valuation which we get, could be 3x of that, right? So
Of course.
and quite honestly, that will not be a fair valuation. That's a very, very frothy valuation. So we take a realistic valuation of the company and accordingly price the ESARs. So please understand, it's not just the liquidity at which it is priced at fair value. It is also priced at fair value when
At
we are
fair value.
giving out these ESARs, right?
Exactly.
So
Yeah.
it's fair at both ends.
Wonderful. Yeah, that's good to know. And just why did you choose? I heard from your one of the articles that you allocated 25% of your valuation of current valuation as ESAR. So why did you choose? I mean, what was your thought process around it? You wanted a certain percentage going to your employees. I just wanted your thoughts on that. Yeah.
As I said before, founders or 4 or 5 people cannot build a company. It requires a good team, big team to build a company. And 10% sounded very small. Therefore, 25. I mean, there is honestly no scientific reason behind 25. Why is it not 27? Why is it not 30? There is no scientific reason. 25, we thought it was a fair number. That's why we increased to 25. Plus, I don't want to have too many variables, right? Like, my job is to reduce number of variables, reduce risk. If the risks are across the team, clients, and stakeholders, I don't want to manage these 3 variables. I only want to manage team and clients. So we
Understood.
essentially decided to combine the stakeholders with the team. Team is a stakeholder, and therefore just manage the team, manage the clients, and we are sorted as a company.
Nice. Nice. And just one question linked to the previous question actually was your liquidity events, right? You mentioned it could be 6 months or an annual exercise for you. So typically it happens in the ESOP world that you have a pool of cash, from either from your investors or your internal accruals to allocate, and then there is a selection or there's a criteria on the basis of which. So is it the same here as well? Because you mentioned you will obviously give out liquidity from the profits that you generate. So
Correct.
based on the profits, you will allocate a pool, and among the vested options, you will have a certain percentage kind of. Is it the same way it will work? Yeah.
Correct.
Okay.
So see, again, as I said, like because the team is a stakeholder, right? So
Right.
no one is going to be foolish about how much money should we spend in buying back. If that money,
Right.
because there are already queries coming in that do we have an option to not sell? And I said, of course, the option is with you to not sell, because
Wonderful.
everyone realizes that the valuation which we had on the basis of the last year's revenue, which was probably, given the pandemic, it was slightly lower than what we were expecting. And the valuation which we are projected to have in this year, of course, April, the valuation will be much higher. And given our product roadmap, both from a product perspective as well as from a sales perspective, a couple of years down the line, the valuation will be much higher. So people are having a question, and of course, like these questions are genuine questions that you are not going to force us to sell, right? So I think, of course,
Wonderful.
not. You'll have an option to hold on to it, right?
That's a great question to answer, I guess, as a founder, saying people want to hold on to their stocks.
Yeah, exactly. And then obviously last year, during the early months of pandemic, right, there was a lot of uncertainty. We were also not sure what is going to happen. Like people were talking about doomsday. People were, ditching currency and investing in gold. I know quite a few people who did that, right? Because people were, speculating, and so there was a lot of uncertainty around our company as well, and therefore we said, you know what, let's take a voluntary pay cut and conserve as much cash as possible, right? So at that point of time, when whoever had taken whatever pay cut, we gave them equity of double the value at 50% discount. So there were also questions that can we have that option even in this year, that can we do away with part of our compensation and get equity at 50% discount. So
Wow.
see, I'm not saying every person in the company is going to be bullish about the company.
Yes.
But as long as most of them are, right? And others, it's my job to bring them onto this side. But as long as most of them are, it's difficult to not be successful from our parameters, and it's easier to become successful. It's easier to experiment, easier to accept failure, and it's easier to have fun on the journey. So that's the whole objective.
So I think it's very, very wonderful. Yeah, the employees looking to take some of their compensation in ESARs itself, and great. And just this is just a couple of questions, and before I let you go, I know you have multiple calls to attend. But do you think SARs? I mean, the stock appreciation right is a better approach, like for a profitable bootstrap venture? Is this a better option? Of course, you answered that in terms of the flexibility and simplicity with which you can execute it. But how would you view it as a instrument versus ESOPs? Yeah, in that regard.
The ESOPs very clearly is slightly more compliance heavy.
Right.
So a lot of paperwork is required compared to ESARs. ESARs is fairly straightforward to also understand because of only one step, involved in liquidation.
Yes, liquidity. Yeah.
A lot of times people don't understand and get surprised when the option lapses on ESOPs, right? Because people just assume that this is an equity which I have received. They don't realize that they will have to exercise, and at that point of time pay money to the company to take these shares, right? So a lot of times,
it's counterintuitive.
They have not invested or they have not thought about it. It's fair also, right? It's not their job to research about ESOPs and understand each and every instrument. It is the founder's job to explain it to everyone. So we came out with a FAQ document where we compared ESOPs versus ESARs. We also answered a lot of those questions around ESARs, that how will the liquidity event happen? What will happen? Did a scenario analysis, shared it with everyone in the company. And then people commented on the same document. We answered those questions. There were a lot of changes which we made into the document because on the basis of the feedback we received. So from a compliance perspective, it is much easier. Of course, it will take a few weeks to implement it and to explain it to everyone. But I think that FAQ document helped a lot, and making it public to everyone to see helped a lot, because then people could see each other's questions, right? And there was and it's easier when you see someone else getting convinced, then instead of coming and asking me those questions, you can ask your peer and be more convinced कि हाँ ठीक है, this is
Right.
the which you want to chase.
And how has been your hiring experience explaining this instrument? Because people would be interested in what is the value that they can create for themselves. And ESOPs are the most standard instrument. So just wanted to understand your hiring experience selling this concept. Yeah.
See, the ESOP story in India has not really worked out, right? It has
Right.
not really worked out. Like you will have your survivorship bias, you will have your 4, 5, 6 companies who have bought back ESOPs, but 99% of the companies or startups which gave out ESOPs, people did not see any liquidity on those, right? So I wouldn't blame people if they are apprehensive about ESAs or ESOPs. They are, right? So it is our job as an ecosystem to start showing that proof that yes, ESAs work, ESOPs work, people get paid for that. There are companies who are raising VC money and doing secondaries, which is good. Why? Because it one again instills faith in ESOPs, ESAs, and you don't have to provide liquidity only from the profits, right? Like what Zerodha is doing, for example. Obviously, again, survivorship
Yes.
bias, right? So
Yes. Yes.
one of the few bootstrapped companies which have attained that scale. So they are buying back
Yeah.
equity, which is a very good example. I think Cred has also bought back equity. Flipkart,
Yes.
of course, when it got acquired, the liquidity was there. I'm sure Paytm and some few other companies also saw a bit of liquidity. But again, we are only talking about few
The
companies,
bigger ones. Yeah.
not majority of the companies.
Yeah.
So I think spending VC money to buy back or do secondaries is easier when there is proof in the model. It becomes very difficult when there is no proof in the model and you're struggling to scale the company. You
Right.
can't ask VCs to buy back equity. So that becomes a very, very difficult conversation to have. Therefore, then people need to have that path to profitability, to start thinking about having a sustainable business model, and then buying back using the internal accruals or profits. Then that makes much more sense. So you will always have very few companies who could use or who will have the ability to use VC money to do secondaries.
Right.
But I think a larger chunk of the companies would be using their profit pool like us,
Right.
to purchase and buy back. So
Sure. So maybe in that context, maybe ESARs make sense. But yeah, as you know, both are equally capable instruments. As we speak, of course, things are changing. In fact, since last 6 to 9 months, actually, almost I think 2 dozen startups are doing some kind of liquidity. But it's fascinating. The things are changing so fast. I think VCs are also evolving in that regard because, like you said, people are the biggest product in that sense, I guess, and everyone realizes that if you don't do it, then you lose out on that front. But a wonderful, Ankur, and maybe the last question was just a lot of first time founders do read about this blog or listen to the fables of ESOP. So what would be your inputs to a first time founders instituting equity compensation program? Any parting kind of advice? Yeah.
find the right people to work with.
Yeah.
And
Of course.
then do not worry about giving out sizable chunk of equity. See, again,
Right.
it becomes easier if you have full control. It becomes difficult if you have investors because then they will also have a say in that, right? They
Right.
will not
Yes.
want to dilute. In our case, like it was just us, Adarsh and I, who had to dilute, and we diluted. But if you have external people, have those external people who are okay diluting a bigger chunk for the team. That helps the team's skin in the game. And see, again, 90% of say $10 million versus 75% of $20 million. What will you prefer, right? So
Math.
I
Yeah.
would always go for the second one.
Yeah. Wonderful. I think this was a very, very enriching discussion. I'm sure people tuning into this will benefit from this, and especially this new concept of SARs. I learned a lot about this, and yeah, I think it's an incredible instrument, and I'm sure certain category of startups will find it very, very appealing to experiment this. Maybe you might get some LinkedIn requests to know more about it, I guess.
Oh, of course, of course.
Yeah.
I'm actually more than happy to share the FAQ document as well. Obviously, we'll
Okay.
remove certain, specific
Sure.
terms and specific numbers with respect to nuclei. But
Sure.
most of the items are quite generic. I'm more than happy to make it available to anyone.
Oh, that's wonderful. So we'll definitely take you up on that and maybe, refer some founders who want more information on this. And yeah, we at Capita are also looking to unlock, bring about making ESOPs and these instruments more mainstream and unlock liquidity at the end of the day. That is what really matters. That is what I think drove you to choose SARs. So wonderful. First of all, thank you for from the ecosystem we have that, you've engaged this and, making good noises about this in the sense that people appreciating this and also putting on an advice just now that giving a large pool is actually might be work in your favor at the end of the day. So thank you for doing it, and thanks for the time as well. I know you're a busy schedule, and hope to
No,
be in
no, thank you
touch.
so much.
Hope
Thank
to
you so
be in
much.
touch and hope to engage with you in the future as well,
Same
Anmol.
here, same here, same here. Take care.
Thank you.
Take care. Bye.
Wonderful.
Thank you. Bye.